Imagine 2008, a time when the world economy was shaken to its core, driven in large part by complex financial products like synthetic collateralized debt obligations. These were complicated financial instruments built on layers of debt, risk, and confidence. When they collapsed, they didn't just affect Wall Street. They triggered a global financial crisis. Fast forward to today, and a similar shadow is starting to loom again. Global regulators have raised the alarm. Banks have now synthetically securitized over $1 trillion worth of loans. In fact, the International Monetary Fund notes that since 2016, more than $1.1 trillion in bank assets have been bundled into synthetic structures. So, what exactly are these structures? Why are they coming back? What are the benefits, the dangers, and could they trigger another global crisis? And what does this mean for countries like India? If you enjoy deep financial insights explained simply, clearly, and with real-world relevance, this is your space. Hit that subscribe button so you never miss a topic that matters but is often ignored. Let's start by unpacking synthetic risk transfers, or SRTs. A synthetic risk transfer is exactly what it sounds like. It's a way for banks to transfer the risk of a loan without actually selling the loan itself. Here's how it works. Imagine a bank holds a big pool of loans. These could be mortgages, business loans, or consumer credit. Instead of offloading the loans, the bank goes to an investor. That investor could be a hedge fund, an insurance company, or a pension fund. They strike a deal. The investor agrees to take on the risk of those loans going bad. In return, the bank pays the investor a premium, like an insurance payment. If the loans perform well, the investor keeps the premium and earns a tidy return. But if the loans default beyond an agreed level, the investor pays the bank. This kind of deal is usually set up through instruments like credit default swaps or CDS. These are basically financial insurance contracts. That's the key difference. It's a synthetic transfer. The loans don't leave the bank's books, but the risk does. Or at least, that's the idea. So, why do banks do this? The answer is capital relief. Under rules like Basel III, banks are required to hold a certain amount of capital against risky loans. But if they can shift that risk to someone else, even synthetically, they can reduce the amount of capital they need to hold. That means they can free up cash to lend more, invest elsewhere, or pay dividends to shareholders. Over the last few years, what began as a niche capital tool has now become mainstream. One expert even called it a pillar of banking strategy. From the bank's point of view, it's like buying insurance on a loan book. From the investor's point of view, it's a high-yield opportunity. They get access to credit exposure without having to originate the loans themselves. It's a win-win. Banks lower their capital burdens, and investors get access to a new stream of income. Now, let's look at where this started. After the 2008 crisis, regulators around the world tightened the rules on securitization. But once they provided clarity around synthetic structures, banks began exploring them again. Europe was first. Around 2012, banks began using synthetic securitizations on small business loans. Then, growth picked up fast. By 2020 and 2021, new European regulations under the STS framework explicitly included synthetic deals, giving them further legitimacy. The United States was slower to follow due to stricter laws. But in late 2023, the Federal Reserve confirmed that United States banks could also benefit from capital relief through SRTs. That triggered a fresh wave of deals. Today, the SRT market spans across Europe, the United States, the United Kingdom, Asia, and even Latin America. This is now a global trend. Let's simplify how it works using an example. Suppose a bank has a loan portfolio worth $100. They're worried about the riskiest 10% of that portfolio, say $10. So, they enter into a synthetic risk transfer deal. They sell the credit risk on that $10 slice to an investor in exchange for regular premium payments. Now, if actual loan losses are, let's say, $8, the investor pays the full amount. If losses are $12, the investor pays $10 and the bank absorbs the extra $2. And if there are no defaults at all, the investor simply keeps all the premiums. High risk, high reward. The benefit for the bank is this. They reduce their risk-weighted assets, which lowers their capital requirement under regulatory frameworks. That means more room to lend or return profits to shareholders. For investors, it's a way to diversify. They can get exposure to consumer loans, SME portfolios, infrastructure credit, and more. The yields can be pretty attractive, often in double digits. That's why even pension funds and insurers have joined the space, not just hedge funds. But there's a catch. And it's a big one. Regulators have flagged serious concerns. One of the biggest red flags is something the European Banking Authority calls the circle of risk. What does that mean? In many deals, the investors who buy this credit risk from the banks are actually borrowing money from the same banks to buy the protection in the first place. Let that sink in. Bank A lends to a hedge fund. That hedge fund uses the money to buy credit protection, maybe from Bank A or another bank. Essentially, the risk that was supposed to be transferred never really left. It just took a ride around the block. This creates a feedback loop. If defaults spike, the investor may not be able to pay up, especially if they're leveraged. And in that case, the losses bounce right back to the bank. It's like a boomerang that was never really thrown. The European Banking Authority has explicitly warned about this. They say banks may be funding the very entities that are supposed to take on their risk. That's not risk transfer, that's risk recycling. In a crisis, that loop can break. And the whole system can snap. And this isn't a small corner of the market. The numbers are huge. As of 2025, Europe's SRT market had grown to over 500 billion euros. Globally, the International Monetary Fund estimates over $1.1 trillion have been synthetically securitized since 2016. That's more than many pre-2008 markets. 2/3 of that total comes from Europe. But the United States is quickly catching up, especially after relaxing its rules in late 2023. And it's not just plain vanilla loans. Many of these deals are built on small and mid-sized enterprise credit. Some are labeled green or ESG compliant, adding yet another layer of complexity. Even a small miscalculation in risk could cascade through the system. So here's the real question. Are we seeing history repeat itself? Back in 2008, banks sliced up mortgage debt into synthetic collateralized debt obligations. When housing prices fell, the losses spread through the financial system like wildfire. Today's SRTs may look neater on paper. The disclosures are better, the rules are tighter, but structurally, they're doing something very similar, spreading risk through chains of synthetic contracts. We've just swapped the names. CDOs have become SRTs, and the illusion of risk transfer still persists. And now, let's talk about India. What's happening here? So far, India has stayed away from this game. The Reserve Bank of India's 2021 Securitisation guidelines explicitly forbid synthetic deals by banks and their branches. In simple terms, Indian banks are not allowed to use SRTs. There is one small exception. Offshore banking units in special financial zones like IFSCs can participate in their foreign parents' SRT program. But back home, the doors remain closed. This means India is legally insulated from the global SRT surge. But that also raises questions. If risk is being transferred or recycled at global scale, could financial contagion still reach Indian shores? Will Indian regulators hold their ground or consider opening the door to these synthetic tools in the future? If India avoids SRTs, it avoids the risk loop. But it also misses out on capital efficiencies that other banks are starting to exploit. It's a tricky trade-off. So, there it is. We've just uncovered a hidden layer of today's financial system. Synthetic risk transfers have grown quietly, but now they're at crisis level scale. The structures are complex, the risks are circular, and yet most of the financial media is still silent. If this video helped you understand the risks behind the gloss, hit that like button. And if you want more deep dives like this, subscribe now. No hype, just analysis. And now, I'd love to hear from you. Do you think India should continue banning synthetic securitizations, or should we start preparing a framework to regulate them safely? Drop your thoughts in the comments. Thanks for watching. Stay sharp, stay curious, and I'll see you in the next one.